Welcome back to the deep dive. We sift through, well, just mountains of research, news, financials on one single stock.
Yeah.
And boil it all down for you, the key stuff you need.
That's the goal.
Today, we're plunging into Kellanova, ticker is K. This company basically changed its whole identity almost overnight.
Yeah, it's fascinating.
We're looking at this, well, former consumer staples giant, really in the final phase before this massive $35.9 billion all-cash buyout by Mars, Inc.
And that's exactly why this deep dive is maybe a bit different for you, the listener. We're not really forecasting out 5-10 years here.
Right.
The basic question, what's this company worth? That's kind of been answered already by a contract.
It's a legally binding one.
Exactly. So our mission today, it's really analyzing that gap, that high-stakes difference between where the stock is trading now and that final fixed payout number.
Okay, so let's just get straight to it then, because, like you said, the conclusion really frames this whole discussion. Our estimate, looking at Kellanova as if it were still standalone.
Independent, yeah.
Based on its brands, its growth.
Yeah.
We put that intrinsic value somewhere in the, let's say, $70 to $80 per share range.
Makes sense. But, and this is the key part, the market right now has it pegged near $82.73.
So why that premium? Almost 5% higher than the middle of our standalone value range.
Because the end game is locked in. The final payout is contractually set at $83.50 cash per share, period. So the whole investment case, it just flips. It becomes a merger arbitrage play. It's really just a countdown clock to closing day, not a bet on long-term growth anymore.
Fascinating dynamic. Okay, so let's dig into what Mars is actually buying here. What is Kellanova today after all this strategic shuffling? Right, let's start with Chapter 1, Business Analysis. A snacking powerhouse at a strategic crossroads. Kellanova, as it exists right now, well, it's the direct outcome of a really calculated move. It plopped into existence October 2023.
Yeah, after they did that spinoff, the North American cereal business, WK Kellogg Co.
Right, the slower growing part. And it was a tax-free spinoff designed specifically to, well, let the value of the faster-growing global snack business shine through.
And you know what? It worked. Snacks are absolutely the heart of it now. Almost 64% of their fiscal 24 revenue. We're talking huge, iconic global brands. Pringles, Cheez-It, Pop-Tarts.
Billion-dollar brands.
Easily. But the really exciting part, the growth engine, it's their noodles and other segment, heavily focused on Africa.
Yeah.
That unit. It reported just exceptional organic net sales growth, 64.1% in Q2 2025. I mean, you just don't see that kind of speed in a company this big very often.
And that scale is their moat,
Yeah.
right? Their competitive advantage. They're in over 180 countries.
Huge footprint. And when they merge with Mars, boom, they become colossal. The third largest global snacking company. Over $63 billion in combined sales. Only PepsiCo and Mondelez will be bigger.
That's some serious scale.
And the industry backdrop, it confirms this snack focus is smart. Snacking, it's like a structural megatrend. Global packaged food compound annual growth rate, the CAGR, expected over 6% through 2030.
But it's not all smooth sailing.
No, definitely not. Even with brands like Kellanova's, you've got serious threats. Lingering inflation is still pinching consumers.
And then there's that newer thing, the GLP-1s.
Exactly, the weight loss drugs. That's a long-term structural risk we absolutely have to talk about. It's not just some niche health trend.
Right.
If these drugs really take hold and broadly reduce impulsive snacking, that could fundamentally change growth expectations for the whole packaged food industry, especially in developed markets. It's a headwind Mars is definitely inheriting.
That's a really critical point on the macro side. Okay, before we hit the numbers, we need to talk about management, how they pulled off this big transition. Let's move to Chapter 2. Management evaluation. Stewards of a landmark transition.
Yeah, execution here was everything. CEO Steve Colleen, his time there, it's going to be defined by the strategy. It was really effective.
How so?
Well, first, he pulled off that incredibly complex 2023 spinoff. That was not easy, but it worked. It got rid of that conglomerate discount that had kind of held the stock back for years.
Okay, step 1.
Step 2, he then nailed the landing, securing this all-cash offer from Mars, and at a premium multiple, too. 16.4 times EBITDA.
16.4. So is there a number we can point to sort of quantify that success? Did the spinoff actually, prove itself financially?
Oh, absolutely. You can see it clearly in their capital efficiency metrics. Kellanova's return on invested capital, ROIC, it's exceptionally strong. It's been running between 12% and 15.48%.
Wow, okay. And compared to the industry?
Way better. The packaged packaged food industry average often struggles to get much above, say, 5.1%.
Big difference.
Huge. And that consistently high ROIC, that's the hard number. The quantitative proof of Kellanova's moat, its brand power, its ability to reinvest profit effectively.
And that justifies the multiple Mars paid.
It directly justifies why Mars was willing to pony up that 16.4x multiple. The market basically saw this super efficient cash machine hiding inside an old structure, and management figured out how to unlock it.
And they're still paying dividends too, right? Until the deal closes.
Yep. They're keeping that reliable dividend going. It's $2.32 per share annualized. The deal explicitly allows them to keep paying that until the merger is done.
So a little extra return for anyone playing the arbitrage.
Adds a bit of sweetener, yeah.
All right, let's dive into the financials themselves. We move to Chapter 3, Financial Analysis. A pre-acquisition financial health check. Looking at the recent performance, reported net sales for the full year 2024, they were actually down 2.8%. But that looks a bit weak initially.
It does on the surface, but you need the context. Always need the context.
Okay.
That reported drop, it was all because of strategic divestiture, selling off parts of the business, and bad foreign currency effects. If you strip that noise out...
Look at organic growth.
Exactly. Organic net sales grew a very healthy 5.6%, and that came from raising prices successfully and selling a better mix of products. Profitability strong, too. Trailing 12-month net margin is sitting at 10.56%. That's a noticeable improvement.
Okay, that makes more sense. But wait, if the core business is healthy, why did free cash flow, FCF, turn negative so far in 2025? Shouldn't that worry us about short-term cash, especially with a huge cash deal about to close?
That's a totally fair question. It looks odd, but again, you got to look why it went negative.
Okay.
That negative $39 million FCF in 2025, it was mostly due to stuff outside normal operations. Specifically, they made some accelerated pension funding payments.
Okay, so not the core business struggling.
No, it's not indicative of a collapse in cash coming from selling snacks. That part remains robust. And their balance sheet looks stable. Debt to equity is moderate, around 1.58.
I also noticed their current ratio seemed really low, 0.68. Usually, below 1.0 is seen as a potential red flag for paying short-term bills. Why isn't that a worry here?
Right, counterintuitive, isn't it? But for a really efficient consumer staples company like Kellanova, that low current ratio is actually a sign of strength, dominance even, not weakness.
How does that work?
It means they're running on negative working capital. They sell their inventory, Pringles, Cheez-Its super, super fast. Stuff flies off the shelves faster than they actually have to pay their suppliers for the ingredients.
So they're using their suppliers' money to fund operations.
Essentially, yeah. They're borrowing from their supply chain interest-free. That level of efficiency, that brand power, means they just don't need to keep a lot of cash sitting around. So the low ratio actually proves how strong their business model is.
Okay, that paints a good picture of the asset Mars is getting. High-quality stuff. Now let's shift focus entirely to the deal itself. Let's look at Chapter 4. Market sentiment. A market price for a merger. Since Mars made the announcement, it seems like market perception is completely anchored to that $83.50 cash price. You look at Wall Street analysts. The consensus is a firm hold.
Yeah, and this is your classic special situation hold rating. It doesn't mean analysts are bored or neutral.
Right.
It means they calculate pretty much zero upside because the stock's already trading right up against that fixed deal price. And conversely, they see very little downside risk because the odds of the deal closing are seen as extremely high.
So the price targets are all jammed together.
Tightly clustered, right around $83.50. It leaves that arbitrage spread, the potential profit, really, really thin.
And other market signals back this up, this confidence in the deal.
They do. Short interest, for example, it's incredibly low. Only about 3.32% of the shares available for trading are being shorted.
Meaning very few big players are betting the deal falls apart.
Exactly. Very little appetite to bet against it. And then you look at the technical chart. The stock is trading firmly, consistently above both its 50-day and 200-day moving averages.
Which sounds bullish, but...
But that positive trend isn't because of some great earnings surprise recently. It's driven entirely by the market just locking the price onto that $83.50 deal value. The merger is the narrative.
Makes sense. Okay, who actually owns this stock then? Let's discuss Chapter 5. Ownership structure. Who holds the keys to the kingdom? It's overwhelmingly held by big institutions, right? They own a massive 83.57% of the shares.
Yeah, the big guys dominate.
The biggest single holder is the W.K. Kellogg Foundation Trust, which owns 13%. And then you've got the usual suspects, the passive giants like Vanguard and BlackRock.
And the Foundation Trust's position here was really the key, the structural linchpin for the deal.
How so?
They, along with the Gunn family, another significant holder, they formally committed their votes up front, locked them in.
So shareholder approval was basically guaranteed from the start.
Pretty much. That took a huge chunk of risk off the table right away for anyone considering the arbitrage.
Okay, speaking of ownership, the data shows insiders have been selling more than buying. Looks like 76 sell transactions versus only 10 buys in the last year. Doesn't that usually make investors nervous?
Normally, yeah, you'd raise an eyebrow. But again, context is king. The vast majority of that selling, especially those regular large block sales, that's the W.K. Kellogg Foundation Trust.
Ah, the big holder.
Right. And this isn't management suddenly getting bearish on the fundamentals. It's part of their publicly stated pre-planned strategy to diversify their holdings to fund their charitable work. Philanthropy.
So given the fixed price.
Given the fixed, all cash prices coming, these sales are just methodical, taking profits near the guaranteed exit price. It's exactly what you'd expect a foundation to do when one of its assets is about to be taken private for a known amount. Totally normal behavior in this situation.
Got it. Okay, last major section before we wrap up. Chapter 6, risk assessment. Navigating the final hurdles. Let's quickly recap the internal risks, the weaknesses we know about. Kellanova is always exposed to commodity price swings. Corn, wheat, sugar prices going up or down. That can squeeze margins.
Sure.
And we already mentioned that demand has been a bit soft in some developed markets like North America and Europe.
Right, those are ongoing business risks. But in this specific context, with the merger pending, the primary risk, the one that could actually kill the small arbitrage profit, it's the non-zero chance of deal failure.
Okay.
If, for some unforeseen regulatory reason, or maybe a financing issue pops up last minute and the Mars acquisition collapses, well, the stock would almost certainly plummet. It would snap back towards that standalone value range we talked about, the $70, $80 area.
That would hurt.
It would. The good news, though, for the arbitrage players is that the biggest regulatory hurdle, the U.S. antitrust review by the FTC, that already got early termination cleared.
So that significantly reduced the deal risk.
Substantially mitigated it, yeah. That was a big one.
What about other external things? Geopolitical risks may be influencing the close.
It's still a factor, absolutely. You have to consider the potential impact of, say, new government policies, like those U.S. tariffs that went into effect in 2025, targeting food imports. Now, this deal is still highly, highly likely to close. But those kinds of tariffs, they add a layer of uncertainty about the future profitability of the combined Mars-Kellanova entity. They could raise input costs, create export hassles for a company with a really complex global supply chain.
So that's more of a risk Mars inherits after closing.
Exactly. It's a business operational risk that Mars will have to manage going forward, but probably doesn't stop the deal itself.
Okay, let's bring it all together then. Chapter 7, conclusion.
So if you synthesize everything we've discussed, the current situation with Kellanova stock, it's pretty much the textbook definition of a merger arbitrage opportunity.
Simple as that.
Pretty much. The bull case is incredibly straightforward. There's a very, very high probability the deal closes at that fixed $83.50 cash price. And until it does, you collect that guaranteed dividend yield.
So the bottom line for you, the listener, is that the company's standalone value, what it might be worth based on fundamentals, it's just completely overshadowed right now by that fixed contractually set price.
Precisely. The investment thesis here isn't some bet on Kellanova selling more Pop-Tarts next year. It's a calculated bet on the legal and regulatory process completing successfully and on time. You're basically trading a bit of liquidity and accepting a small, manageable risk in exchange for a small, defined return.
Okay. And as we wrap up this deep dive, we always like to leave you with a final thought, something to chew on.
Right. Think about this. Kellanova managed to get acquired at a really nice premium. And a key reason they could do that was because they strategically split the company up first. They spun off the low-growth stuff to really highlight the potential in the high-growth snack portfolio.
Made themselves a more attractive target.
Exactly. So the question this raises is, what other big, maybe slow-moving consumer staples conglomerates out there are currently trading at that kind of conglomerate discount? Which ones might be the next candidates to pull a similar move, a strategic spin-off, to try and unlock shareholder value that's currently dormant?
Something to think about as you scan the market. Definitely food for thought. If you found this deep dive helpful, please do hit like and subscribe to Stock Analytics AI. For just $4.99 a month, members get priority access to deep dives like this one. We're covering all the S&P 500 stocks over the next few months, and members get first dibs.
And if you just want a one-off analysis on a specific ticker, dropping us a super thanks is a great way to do that.
Absolutely. And finally, the necessary disclaimer. This analysis was generated by an AI system. It's for educational purposes only.
Yep, it should definitely not be taken as financial advice. Please always do your own thorough research, or better yet, talk to a qualified financial advisor before making any investment decisions.